this accounting for income taxes chapter. Okay, so today we have to discuss about the like how come the deferred tax assets and liabilities are created. Okay, so here we can see a slide, and here we can see there are two blue boxes and two yellow boxes. So we will see because of these things whether DTA, deferred tax asset, is created or deferred tax liability, and because of this even like I would repeat what is created. Okay, so let's see with an example. Installment sales. See what happens in the case of installment sales. This is accounting, like this is financial reports, this is tax returns. So installment sales, you will recognize that completely here, because we recognize the incomes when we earn it rather than receive it. Since you recognize the entire installment sales amount here in financial report, your accounting profits are high, and you show the installment sales in tax returns when you really receive the installment, because it works on cash basis. So you receive the first installment at the end of first year maybe, and here you show it later. So tax returns or taxable profits are less. So when accounting profits are more, your income tax expense is high, or your provision is high, and your tax liability or whatever the tax you're paying is less. That means you pay less taxes, but your provision is more. That means DTL is created. Okay, that is very clear. So deferred tax liability is created because you're paying less and you're creating a higher provision. So suppose you create a provision of 20,000 and you pay just what we say like 12,000. So 8,000 is your DTL. Okay, point number 2. Then comes unrealized gain for recording investments at fair value. That means unrealized gains are nothing but such gain where you have not received cash. But when we prepare the financial reports, we show all the incomes when we earn it rather than receive. So accounting profits are high than the tax profits, and then DTL is created. Same thing. Okay. Third point. Then comes the accelerated depreciation on tax returns. So what happens? This is like accelerated depreciation, not accumulated, accelerated. So financial reports and then tax returns. So what happens? Your depreciation amount is high here. That means your tax returns or taxable profit is less because of higher depreciation here. Tax profit is less, and accounting profits are more. So provision would be high here. Income tax provision or income tax expense would be high. That means that creates a DTL. Why? Because you are showing a higher provision. Suppose like you're showing 20,000 and you're paying less. You're paying suppose 12,000. So 8,000 is your DTL. Okay, that's understood fact. And the next one, prepaid expenses. That means you already paid it. It seems you already paid it, and you have shown that here in the beginning, but you showed it later here. So again, taxable profits are less and DTL is created. Accounting income is higher than tax returns. Okay, tax profits. That's what. So these four things create deferred tax liability. Now let's say about the deferred tax asset. We will speak about the yellow boxes. So temporary differences in the yellow boxes. So we'll discuss about the yellow boxes now. Rent or subscription collected in advance. So we'll see income received in advance. How would you record that? So income received in advance. This is accounting profits. This is tax return. And here, when you receive the entire cash, you show it here. So here your taxable profits are high, your accounting income is less. So you paid more actually. That means tax paid is more and the provision is or income tax expense is less. So you paid a higher amount and the provision you're showing is less. So that creates a DTA, deferred tax asset. That means in the future, when you'll be paying taxes, the higher amount what you paid or the extra or additional amount what you paid can be used to adjust with the future taxes or can be deducted. Okay. So next comes other revenue collected in advance. So any revenue collected in advance, here your DTA is created. And the next point here, estimated expenses and losses. See, in like estimated expenses, what happens in the case of accrual concept is you estimate expenses. That means bad debt expense, because you know out of your business, out of your experience, since we've been doing a business since long time, every year how much bad debts you would incur. So you make estimates. These kind of estimates have no place in the income tax when you file income tax returns, because estimates and all are concept of accounting. Your tax authorities or tax rules or tax codes doesn't give a permission for all this. So here what happens when you show the provision beforehand, your accounting, since you're showing a higher expense, your accounting income is less, so provision for tax is less and taxable profits are high, tax paid is high. That means you paid more and you're showing less provision. That means DTA is created. And the last discussion is about the unrealized loss. That means the loss which you have showed here, it seems, because unrealized loss is nothing but the loss is not in the form of cash payment. Okay, that means you have incurred a loss, but you did not pay something out of your pockets, which you don't show in tax returns. So again, taxable profits are high, tax paid is high, and again DTA is created, and here it is vice versa, all less. Okay, so this is the discussion for this. Let's move forward and do a question of DTA and DTL calculation. So please read this question. Okay, so I think hopefully you have understood the question. In 2006, Baxter reports 3 lakh of pre-tax income, and included in this amount is 1 lakh resulting from revenue earned from an installment sale. So this 3 lakh has 1 lakh like installment sales amount. That means in case of accounting income, you will be recognizing the installment sales amount even though you don't receive it, because the concept here is if you earn it, you show it. It doesn't matter whether you received it or not. But in case of taxable income or when you prepare income tax returns, the receipt aspect is very important. That means if you receive this 1 lakh, then only you can show in the tax returns. So definitely that is creating a difference of 1 lakh between the accounting income and the taxable income, which is in the tax return. Because here you have shown 1 lakh already, here you haven't shown, but that 1 lakh you would be receiving in the future as 70,000 and 30,000 when the installments are paid in form of cash. So when physical cash is received, that would increase your tax returns income. Okay, for that matter, let's read the entire question. So in 2006, Baxter reports 3 lakh of pre-tax income included in this amount. Excuse me. Included in this amount is 1 lakh resulting from revenue earned from an installment sale. So this has that revenue earned from installment sale for which no cash was collected. So that, cannot be shown in the tax returns when you like prepare it, but you can show in the books of accounts or accounting profits when you prepare the financial reports. So the revenue will be taxed as the cash is collected in 2007-8 in case of income tax returns. That means when you will be receiving this 2 installments in the future, then that will be taxed. Actually, the tax is paid based upon the income tax returns, not the financial reports. You should understand. So the tax would be in the future, it seems, because when you receive the cash for them, you will be paying taxes for this particular 1 lakh amount, which is divided into 2 parts, 70 and 30. So so that's what they're saying. Baxter expects to collect 70,000 in 7 and remaining this much in 8. And revenue will be taxed when the cash is collected. That is pretty simple, clear information. In 7 and 8, Baxter reports 2 lakh of pre-tax income. The company is subject to 32% tax rate. So yeah, like in 2007-8, Baxter reports 2 lakhs. So this is like 7 and 8, your pre-tax income is 2 lakhs. So you should know this. So they are giving that in the question. Okay, so this is the question all you have. Now let's go for the solution part. So like your accounting income is 3 lakhs. So 3 lakhs. This is the accounting profits and this is the tax return. So 2 lakhs is what you're showing here. So on this 32% is how much actually? Just calculate in your books. So it is 96,000. So this is the tax provision, and here into 32%, 64,000. This is the tax paid actually. So income tax expense is 96,000. You have paid 64,000. So the difference is 32,000. That is nothing but your deferred tax liability, DTL, which will reverse in the future. Okay, either you can do in this way or else you can do one thing. You can directly take accounting profits, alternate method, and you can take tax return. You can see the difference in both of them. The difference is simple, 1 lakh. And on that you can directly apply 32% tax, that is 32,000. And you can see which income is more. See, the accounting profits are more than tax returns. So this creates what? Please tell me, DTL, yes or no? Yes, I'm not hearing any voices.
Yes, sir. Yes.
Yeah. So now we will pass the journal entry for this. So see, deferred tax liability 32,000. So your income tax expense is 96,000. Your tax liability or payable is 64,000, and DTL, that is a long-term liability, is 32,000. Okay. This would reverse in the future. How it would reverse? Again, I will tell you to take the alternate method. The alternative method is, see, accounting profits you take, tax returns you take. The difference between these two is 70,000 in the next year, correct? And 70,000 you are showing here. It is having the 70,000 balance is more here, correct? You can check the slide. This is where this is accounting income, this is tax return or taxable income. So this is more and this is less. So here into 32%. So when tax returns or taxable profits are more than accounting profits, DTA is created. That means I would say this would reverse in the future. How it would reverse, I will say you. So you get 22,400. This would reverse. So 32,000 minus 24,000. That means you have to pay this much taxes in the future, correct? And since your tax returns is more than accounting profits, you are paying an advance tax of 22,400 in the next year. That means this liability, from this we will settle this much. So how much is left over? 9,600. So this is the one which again has to be reversed in the next coming year. So next coming year again, accounting profit tax returns. This is more than this, and the difference is 30,000, correct? You can check the slide. So 30,000 into 32% is how much? It is 9,600. So again 9,600 got reversed next year, 0. So in this way, the deferred tax liability which was created got reversed. Okay. If you want to do in this method, you can do this method, or else you can do this method also. You can take this full income and this full income. So you can take accounting profits, you can take tax returns, you can take 2 lakh here, and you can take 2,70,000 here. You can calculate tax 32%. You can take tax 32%. So that method is even easy. This method is also the one which you can follow. So here comes 64,000, and here 2,70,000 into 32% comes 86,400. So as you can see, the provision what you created is 64,000 and you paid tax of 86,400. That means difference of how much is created? 22,400. This is what is the reversal of the DTL previously created. Again, next year, again accounting profits, tax returns. Again, you will take 2 lakhs here and you'll take 2,30,000 here into 32% into 32%. So here it would be 64,000 and here it would be 73,600. Again, you paid more. So how much you paid more? 9,600. Okay, so again this got reversed. Okay, so the total 22,400 and 9,600 got these two things are reversal of deferred tax liability. So your deferred tax liability of 32,000 has got reversed, and definitely in the future it would get reversed. It got created because of the timing differences. So you can check this. We will pass the reversal entry even. So next you just check it here. See, income tax expense. This was the entry you have seen in the previous past, correct? So this is 32,000 your DTL and it got reversed by this. Now you see the reversal entry. So what happened here? In the next coming year, your tax liability was 86,400, correct? But the provision what you created is 64,000. This is income tax expense. So 64,000 is expense. You pay your liability is this much. This is your reversal of DTL. Because your DTL deferred tax liability was in the credit. Now we will reverse this 32,000 by how much amount? 22,400 in the year 2007. So that got debited. And in the coming year, only 9,600 is left over. That will be reversed. You can see the reversal. So the expense is this, the liability is this, and the reversal of DTL has happened of this much. And here 32,000 has completely got reversed, okay, by this year. So they see here 32,000 you were showing, 22,400 got reversed, this much was supposed to be reversed, and this much you got again, it got reversed. Okay, zero balance in this. Okay, so you can have a look through all this. We'll go for the next question, that is DTA, deferred tax asset. Okay.
Sir, can you share this slide on WhatsApp?
You already have this. Would I share this slide now?
Okay, okay.
Now let's go for the next question and read this. I can share this on your Skype. Don't worry. Share it immediately.
Thank you, sir.
Got it now?
Yes.
Yeah. Okay. Just read this, please. Now, Health Magazine received 1,50,000 of subscriptions in advance. So you can understand when you receive income in advance, you can show that in tax returns, correct? But that has no place in the accounting income at first. But see, like for example, if someone paid me advance rent, suppose rental is 10,000 per month, and my tenant has paid me 1,20,000 in advance. So this I can not recognize as an income. This is called unearned revenue or income received in advance. Anything you can see, anything you can assume. Okay, assume in the sense it can be anything. You can just say this or this. So this is a liability. It's not an asset. Of course not. It's a liability because whenever the tenant wants to go in between, I have to give that money back to him, and I cannot expect to. I cannot even term it as an income. Why? Because the first month has not passed. So when 1 month passes by, so 10,000 becomes my revenue, and still my liability is 1,10,000 in the liability side of balance sheet. So what happens after the full year has completed? 1,20,000 I'll recognize as revenue, and my liability is not existing now. Why? Because I have given the service and I've earned for that. So since 1,20,000 on the first day is not a revenue, it's a liability. It's revenue at the end of the year when I give full service to my tenant. That means when he really enjoys the benefit of like the property on rental basis, then I can assume that I'm really earning something. Okay, so this is a liability, but in tax returns, this is not a liability. This is a revenue. Why? Because the entire money they have received, and it works on receipt basis. Okay, so you received cash, you show it as a revenue. So there the difference gets created. So here I'll say you something very clearly. What is created? So 5 lakh your accounting profits are 5 lakh, your tax returns is 6.5. Here you are showing this is more, taxable profits are more, accounting profits are less. So when taxable profits are more than accounting profits, it creates DTA. Why? Because you'll be paying more tax on this higher amount and your provision would be less. So DTA is created and that would be reversed in the future. How? Let's see. So very simple. You can do this also in two ways, like that method, like directly taking the difference and finding out the the DTA and then reversing it in the future. I'll explain you that very simply. 1,50,000 you can take the difference amount between the accounting profit and tax returns. 1,50,000. It's a difference amount into the tax rate directly. It's how much? 30%. So it's like 45,000. This is your DTA, which has to be reversed, and definitely it can be reversed very easily. We can see 50, 50, 50, three differences in the coming years. So 50, 50, 50, this will be in the accounting profits. The amount would be higher in accounting profits. That means in these three cases, it is more than the tax return, more than the tax return, more than the tax return. So whatever DTA has got created, that will be reversed into 30%. So 15,000 into 30%. So 15,000 into 30%. So 15,000. So this 45,000 is reversed by this, this and this. OK, in the coming years. Very simply understood. If not, then you can do one thing. You can take accounting profits. You can take tax returns. You can take 5 lakhs. You can take 6.5 lakhs. OK, you can take 30%. That is 40, like 5 lakhs, 15, 1,50,000. You can take 30% of this. How much? Just tell me. $1,95,000. And you can see here, that means your provision is less, you have paid more. So 45,000 is your DTA. That has to be reversed. So next coming year, accounting profits and tax returns again you can take. So 555. So 5,50,000 and 5 lakhs. So I'll do for the first year. Next rest of the years also it will be same. That is the tax you will be paying on your profits. Year 1,50,000. Here again 5,50,000 into 30% is how much? 1,65,000. And then you have paid less. Here it is more. So again, what difference is created? 15,000. That means reversal of DTA has happened by 15,000 in the coming year. Next year, again 15,000 the next coming year, again 15,000 the next coming year, because the amount would be the same. OK. So let's now go for the journal entries. So here you can see 45. Then next year reversed, 15,000 got reversed. Then 30 is left over to reverse. Next year again 15,000. See, 45 is what you got now. Again next year 30. That means 15 reversed. Again next 15. That means 15 more reversed. Again 15 reversed, 0. OK. So 15 reversed here, left 30. 15 reversed here, left 15. 15 reversed here, left 0. So let's see here. Your tax expense is 1,50,000, which we have calculated. And your tax liability or payable is 1,95,000. So deferred tax asset is 45. That comes in debit. Again, it will reverse. It will be reversed and it come in the credit. Next, you can see debit side deferred tax asset, because deferred tax asset is a long-term asset. It shows debit balance. Deferred tax liability is a long-term liability. When you make or prepare that account, you will be writing it in the credit side. That's a long-term liability. Liabilities always show credit balance. Next year, income tax expense 1,65,000 as I've shown, and your liability is 1,50,000. And DTA got reversed by 15. Again next year the same thing again comes, reversing leftover balance. Again 15 will be reversed. 15, 15, the same entry would continue. So this will be an end. OK. So now we don't have valuation allowance and all these things in your syllabus. I'm going with last and final thing. I have explained you about the temporary differences. What about the permanent differences? See, permanent, this is accounting profits, this is tax returns. See, permanent differences are created when you show something in your accounting profits. That means when you prepare financial report, you will show some transactions in this, but you won't show that in this at all. Because of that, this will either have a higher amount and this will have a lower amount, and then again the DTA or DTL is created. That means some things which you would be showing in this have no place in this. Some examples I would write here: penalties and fines. So penalties and fines you can show as an expense in accounting when you prepare financial reports. Penalties and fines you can show as expense in financial report. That means sometimes you'll be caught in something, some criminal, some civil, or some kind of law breaking. You'd break law. So like suppose company like company's employees coming in a car, and because of speeding, over speeding, he has like jumped us, he has kind of done over speeding, and because of that fines are levied. That's a it's a vicarious liability for the company. That means the employees loss, employees using company's car, so company has to pay that fine. So they will show it as an expense, but that cannot be shown in the tax returns. It's a personal thing for company. Okay, that is not, this is not deductible. That means deduction is not given for this in the tax returns. Only it can be shown in the accounting profits. Correct? That means this is allowed in the sense can be shown in the accounting profits, but disallowed in tax when you prepare the tax returns. Correct? What do you say? Understood?
Yes, sir.
Yeah, next one.
Yes, sir.
You cannot reduce your tax based upon this kind of expenses, penalties and fines. Meals and entertainment. Again, meals and entertainment you can show in this, but not in this. No, you cannot show, you cannot deduct. Okay. So see what happens. See, companies can expense 100% of cost to provide business related meals and entertainment that they incur in normal course of, see, you know, many of the companies, they have meetings and all, then they provide meals to their employees. However, tax purposes, the business can expense the most, only 50% of that same cost unless certain exceptions. That means like in tax also 50% deduction and 50% you should show something would be there. Again, this difference would be created. Life insurance like proceeds. So if some suppose this is a company and they receive some life insurance upon death of an employee. Okay, it's income for the company, but not a but never it can be shown in the taxable income. Okay. Okay. Because life insurance paid by the company for employees is an expense for company and can be shown in the financial reports, but they cannot be shown in the tax returns. No deduction. In see some incomes like, you know, if you take NSE bonds, National Savings Certificate bonds, in for when you invest in these bonds, you'll get interest, and those interests are exempted from tax. That means you cannot show them in the tax returns which you are preparing. Why? Because it is exempted from tax. No, it is exempted. You cannot show that. Government gives you you need not pay tax on that. It's exempted. You need not pay tax on it. Exempted. So they cannot be shown in the tax returns, but as an income can be shown in the financial reports. Okay, and some dividends also. Some are like what we say. Sometimes they exempt dividends also in some cases. Okay, but in some cases they charge. Okay, so in that case also you won't show in the tax returns and you show in the accounting books. So permanent differences are created. And one more thing, permanent differences cannot be reversed. Why? Because something is shown in this but cannot be shown in this. So there is no chance of reversal now, because if I show something in this today in advance and something I'll show in this in the future, then of course here I would have paid more taxes and here I would have paid less taxes, but in the future I'll be paying more taxes or less taxes. That then see here, if I shown some income of 10,000, here I did not show. So here I have my provision is more, tax provision or income tax expense. Here it is less. So DTL is created, but in future I'll be showing that income here. So because of that, I'll be paying more taxes here, and then DTL will get reversed. But when you show something in this and never show something in this at all, there is no chance of receiving that income in the future and more and reversal of any of the deferred tax asset or liability, correct? So permanent differences cannot be reversed. Fine. So this is what is the end of the chapter accounting from income taxes. Let's start the chapter called accounting from investments tomorrow, and I'll finish that chapter also tomorrow. Okay. Thank you.
Thank you, sir. Bye.
Thank you.